Australian and global equity markets are on track to score a hat-trick, delivering 3 years of robust gains.
But 2025 wasn't smooth sailing. Trump tariff headlines and bouts of stomach-churning volatility tested investors all year.
And as we head into 2026, investors are grappling with stretched tech valuations, heavy AI capex, and ongoing uncertainty around interest rates.
The market's resilience has surprised even the optimists, and it begs the question, does this rally still have fuel left?
So we're asking the fundies, where do they see the biggest opportunities in 2026?
What's the biggest opportunity you see in markets heading into 2026?
We strongly believe that small caps are the place to be. I know we're a small cap manager, but if you look at the history of relative valuation, small cap versus large, it's currently at a 2 standard deviation discount globally, small caps to large in terms of PEs. And so we think that's where the opportunity is. The reason I think that's come about is because of all this passive money that's come into the market, and it's eschewed, I guess, small companies and micro-cap companies. And so it's kind of distorted the market, and that means there's a lot of inefficiency down the market cap spectrum in terms of valuation. And the valuation, I guess, is where we make our money. If we can find companies that are undervalued, I think over time that's going to be recognised by the market, even though it's not in the short term. So the big opportunity is definitely in small caps, whether it's global or domestic, it doesn't really matter.
2025 was a very strong momentum year. There was momentum in loss-making stocks, momentum in resources, momentum in growth and technology. So for me, there are a lot of opportunities in all of those areas, and it really is driven by earnings. And the earnings are actually quite strong in this market going into 2026. So the opportunities are significant, and there are around those themes. So resources, materials, and growth, and they are quite material.
One factor that's been huge at the back end of 2025 has been the death of software theme. We've seen companies like Xero and WiseTech in Australia fall 40 and 50%, and that's been even more extreme in the US. I'm really happy to take the other side of that trade. I think there's lots of great opportunities out there in that sector, particularly in the US, for those software companies to overcome the concerns in 2026.
I think it'll be a continuation of what we've seen in 25, and that's in the materials and resources sector. With the amount of energy transition construction and activity, with data centre construction, demand generally for commodities is going to be strong and remain strong. And I think interest levels will remain very buoyant for commodity type stocks. And that has great ramifications for 25% of the Australian share market, which is the resources sector. So I think that will continue strongly. I'm not so worried about the fact that China is a stop-start recovery story. It's all about Indo-Pacific, the Indo-Pacific basin, and the strong growth we're seeing from economies like India, where we had about 6.5% growth likely for this year, GDP growth, and looks like the same for next year. So I think we're in for a very buoyant commodities market, and resource stocks will continue to do well.
Well, I actually think it's the rebound in quality investing. If you look over the really long term, quality companies have been shown to outperform the overall market kind of fairly consistently over that long time period. But last year, we actually saw a lot of speculation in markets. Quality companies, measured by a simplistic metrics like ROE and so on, underperformed by about 9% last year. So that's a pretty unusual situation, doesn't tend to persist. So we're thinking 2026 is likely to be the return of those quality companies where we're seeing some really good valuations as well in a fairly stretched market.
I think the biggest opportunity is going to be AI dislocations, particularly in software. So there's obviously been a lot of headlines around the mega caps and AI infrastructure plays on the whole AI front, but there's been a lot of opportunities created in software. Now, I think the baby's been thrown out with the bathwater because you've seen a lot of high quality companies being markedly derated because people think that their business models are under threat from AI. Things like vibe coding and AI startups and the whole open server kind of infrastructure world, people are thinking that that's going to overtake some of these software names. Take something like Atlassian, for instance. It's down 50% from its peak this year, and it's still doing revenue growth of more than 20%. It's got 3.5 million monthly users using its AI features. And the kicker is, people who use Vibe, or companies that use Vibe coding software, they're actually seeing an increase in seats on Jira, more so than those that aren't. So I think that there's a real opportunity in these high quality, defensible, competitive moats that quality software players have in the whole AI world.
For the first time in years, we have cash rate divergence. We have hikers and we have cutters. Australia is now firmly in the hiking camp, while the US is cutting, despite both economies actually looking pretty strong into next year. So then when you overlay these monetary settings, we expect an acceleration in the US consumer and maybe a slight dampening in the Australian consumer. So how do we think about that from an ASX perspective? We're looking at Australian companies with US cyclical exposures or exposures to the US consumer. Now, this trend is slightly dampened by the Australian dollar. We do expect Australian dollar strength, but we think this trend will override that, and it's underappreciated by the market at the moment. Overall, I would say though, we are positive on the market. We believe the Fed sets the tone for risk assets globally, and we have good global growth ahead, so we think equities can continue to rally from here.
I think 2025 was a good start of what should be a multi-year period in terms of that rotation occurring, large caps starting to come back down into small caps, and hopefully through time back into micros, and just that breadth opening up in the markets where investors are starting to look at parts of the market they've been ignoring for a couple of years. Some really good value on offer. Dynamic companies, nimble companies, growing companies, good valuations, just that whole view of that rotation and that money start to filter back down.
We think the real opportunity is actually in active management. It's obviously been a difficult couple of years for active in Australia and globally. The performance of passive indices have done particularly well. In Australia, the banks have performed exceptionally well. But going forward, the move to passive is actually creating a lot of volatility. And we think the volatility is going to be advantageous for genuinely active managers. So I think not just for 26, but for the next decade, you're going to want to pick your most trusted active manager and stick with them for the next decade, because a lot of the companies at the large end of the market, they're facing all sorts of competitive and revenue and earnings threats on a go-forward basis. So the real opportunities are going to sit outside the very biggest companies.